It's May 8th. We've got one company today, but it's an interesting one. Hen, ticker 4475, just dropped their interim report and there's a real tension in the numbers.
Yeah, this one's kind of a puzzle. Top line looks fine, but the cash flow story is weird.
So Henninja, SaaS platform, Henninge One is the core product. Sales grew to 6.1 billion yen, up about 18% year over year. But operating cash flow went negative, minus 36 million. How does that happen with a growing SaaS business?
Two things. Contract liabilities dropped, which means they recognized a bunch of deferred revenue. That's actually good. It means bookings from prior periods converted to revenue. But prepaid expenses jumped, and that's cash out the door. So the profitability is real, the cash timing is just off.
Okay, so the OCF dip is maybe not alarming on its own, but then I see financing outflows of over 1 billion yen. That's the real story, right?
Exactly. 913 million yen on share buybacks alone. They spent almost 1 billion yen repurchasing stock in one quarter. Plus another 159 million in dividends. That's aggressive capital return for a company at this growth stage.
Cash position dropped from 7.3 billion to 6 billion, so they're funding buybacks from the balance sheet, not from operating cash. That's a choice.
It is. And the growth is decelerating. One sales up 19% interim versus 33% last fiscal year. Professional services actually declined slightly. So management seems to be saying, we're growing slower, so let's return capital. The churn rate improving to 0.26% supports the stable base argument.
They're not sitting still on product, though. New endpoint security bundle launched in March. PassPack Alliance for password management, AWS certification for the email product. That's 3 strategic moves in one period.
Right. And the Hiroshima office opening to expand regional sales. They're investing in distribution even as growth slows. But the buyback magnitude raises a question. Are they signaling confidence? Or are they running out of high-return reinvestment opportunities?
Good question. The restricted stock compensation plan for directors, 17,700 shares, also feels like a retention move when you're decelerating. Keep the team locked in through the slower growth phase.
So Henning, profitable SaaS with improving churn but decelerating growth and aggressive buybacks. Watch whether that OCF normalizes next period or if the cash burn pattern continues.
Exactly. If contract liabilities keep declining without new booking growth, that cash cushion gets thinner fast. That's the tension to track.